Hi, this is Ron Cipcic, and this is the second part of a three-part series on the case for free trade. We investigated in part one the concepts of absolute and comparative advantage. We learned in part one that absolute advantage is being able to produce a product at the lower resource cost, whereas comparative advantage is being able to produce the product at a lower opportunity cost. The table we have presented here is a presentation and a continuation of the green thumb, five thumb example where both gardeners produce corn and tomatoes. This table shows one of the results from part one where we had converted the cost of corn into tomatoes and the cost of tomatoes into the equivalent amount of corn. What we see here is that five thumb actually has the comparative advantage in corn because he produces a bushel of corn at a lower opportunity cost in terms of tomatoes than does green thumb. On the other hand, when it comes to tomatoes, green thumb has the comparative advantage in tomatoes because she produces a unit of tomatoes, a bushel of tomatoes, at a lower opportunity cost, 1.5 corn, than does five thumb. So as we see in this table, each of the traders, each of the producers has a comparative advantage in one of the products. Now, what we're going to learn in this particular part of the problem is that the party with the comparative advantage ought to be the seller. So in this case, five thumb ought to be the seller of corn, whereas green thumb ought to be the seller of tomatoes. So the principle here is that if you have the comparative advantage in a product, you ought to specialize in that product and be the seller of that product. Whereas if you do not have the absolute advantage in a product, you have the comparative advantage in a product, you should actually be the buyer. So in this case, the buyer of corn will actually be green thumb. Green thumb does not produce corn at the lowest opportunity cost. Therefore, green thumb ought to be the buyer of corn. And as we flip it over to the tomato side, five thumb ought to be the buyer of tomatoes. So now we see that the world is dividing into two basic parties, sellers and buyers. Sellers being that party that has the comparative advantage, where buyers are that represent the party that does not have the comparative advantage, that actually has the comparative disadvantage. And we can see the foundations for market theory beginning to develop, that the world divides into two basic groups, sellers and buyers, and that this division is on the basis of something called comparative advantage. Now I'm going to move this image up so I can continue to write, and let me do that very quickly. What we're going to see here is we can develop a trading zone for each product. In other words, based on comparative advantage, there will be a seller and a buyer, and there will be a trading zone in which those two parties can operate. So let me go ahead and switch back to the marker function here. We're going to set up an image of this trading zone. So let's label this the trading zone. And this is going to be the trading zone for tomatoes. We'll do tomatoes. We could have just as easily done this for corn. And in essence, what we're going to be doing is we're going to be looking at the market for tomatoes. There will be an upper limit and there will be a lower limit in this trading zone. The upper limit is set by the buyer's maximum price. The lower limit will be set by the seller's minimum price. So the buyer will only pay so much for tomatoes. The seller will only take so little for tomatoes. And this is true of really any product. The buyer always sets the upper limit. The buyer will only pay so much. and the lower limit is determined by the seller, who will only take so little. Now, if you recall, the buyer of tomatoes is going to be 5 thumb. So let's label that. The seller of tomatoes is going to be green thumb. So let's label green thumb as our seller. Now, just a reminder that 5 thumb, in 5 thumb's own garden, 5 thumb has a conversion rate for tomatoes. He can trade for 1 tomato, he has to give up 2.5 corn. Whereas if we look at green thumb, to get a tomato, she has to only give up 1.5 corn. Now this data, of course, is taken from the table we just looked at. Now, the important thing to keep in mind when you're considering a trading zone is that the seller of the product in question, in this case the product in question is tomatoes, the seller of the product will actually be trying to get rid of tomatoes and actually be trying to get her hands on corn. So corn will actually be the objective of the seller. So the seller wants corn and is willing to give up tomatoes. Being the seller of tomatoes means you're trying to get rid of tomatoes, you're trying to get your hands on corn. Whereas the buyer of tomatoes is actually trying to get tomatoes and is trying to actually give up corn. So in 5 thumb's own garden, he can give up 2.5 corn to get a tomato, and in green thumb's garden, she is willing to give up a tomato to get 1.5 corn. Now, would the seller of tomatoes, here's the question, would the seller of tomatoes be willing to make a tomato and sell it for more than 1.5 corn? The answer is yes, because in her own garden, she can get 1.5 corn for every unit of tomatoes. She would be very, very happy to make a tomato and trade it away for more than 1.5 corn. So any exchange rate, now let me pick a color here that we can use. Let's use orange. Well, there we go. Tangerine. Isn't that cool? Any exchange rate above 1 tomato equals 1.5 corn would be pleasing to the seller of tomatoes. So we'll actually illustrate a few of these in a minute, but the seller, of course, is going to be open to any price above this line right here. The buyer, on the other hand, let me pick a different color here. We'll go with orchid. The buyer is after tomatoes and would be willing to pay anything less than 2.5 corn for a tomato. So the buyer is interested in any exchange rate that's actually below that upper line. So you can see here that there's a trading zone. This is the trading zone right here. Any exchange rate, and I'll be explaining this more in our next lesson, in lesson 3, but any exchange rate that falls within this trading zone is going to benefit both seller and buyer. Any exchange rate that falls outside this trading zone will not benefit one or the other party. For instance, we can pick the midpoint here. Let's do that. I'll go back to red, and let's just pick the midpoint in this zone. Now this is going to be 1 tomato equals 2 corn. Notice that falls below the buyer's maximum price and falls above the seller's minimum price. Would the seller be happy to make a tomato and trade it away for 2 corn? The answer is yes, because in her own garden she could trade a tomato away for only 1.5 corn. So she's happy to get 2 corn for a tomato, where in her own garden she can only get 1.5 corn for a tomato. He, on the other hand, being the buyer, is after tomatoes. Would he be willing to pay something less than 2.5 corn for a tomato? And the answer is yes. So he'd be very happy to pay 2 corn for a tomato because he's after tomatoes and he wants to pay as little as possible for that product. So we can see that the exchange rate of 1T equals 2C, while it falls right in the middle, and we'll talk about that further, it is an exchange rate, one of many that could work anywhere in this zone. Actually, any exchange rate in this zone, any, whether it's above 2C or whether it's below 2C, any exchange rate in this zone is actually going to result in mutually advantageous trade for both the buyer and the seller. Now, where that exchange rate actually falls in the zone is going to depend upon the relative market power of the producers. For instance, if you think of an automobile example, if you buy a car, let's say we're talking, if we're talking about a new automobile, we're going to be seeing that if we're talking about, say, a 2014 automobile, that comes out in the summer of 2013. So when those 2014 models come out in the summer of 2013, they're going to be very hot and popular. There's going to be a lot of sizzle around that introduction usually. And it's going to be very, very difficult for buyers to get an extraordinary deal on one of the new models because they're just coming out. There's a lot of interest in them. So early in the model year, which is the summer prior to the calendar year by which the car is named, the seller will have much more market power, and you'd expect that the price of the car would fall higher in the zone. Whereas later in the model year, say we're actually talking about June or May or June of the actual calendar year that the car is named, say May or June of 2014, just prior to the introduction of the 2015 cars, well, you can imagine there's going to be cars on the car lot that the car dealerships are going to be very, very willing to try to get rid of because those 2015s are coming in. So they're going to be very likely to want to make a deal on the 2014s. In that case, you'd expect that price would fall lower in the trading zone, closer to the seller's minimum. So early in the model year, the price is going to have to push up here near the top, will likely push up here near the top because the buyers do not have much market power. But later in the model year, when the sellers are trying to move the 2014s off the lot and get ready for the 2015s, after all, the car lot space is scarce. And we want to put cars on that space that for a car dealership, we want cars on that space that are most attractive, most profitable. So we're going to be very interested in unloading the 2014s at relatively low prices down here and bringing in those 2015s where we would expect to get better profit margins and higher prices up here. Notice that any price outside the zone, well, let me just pick, let me see if I can find a different color. I can find a different color. We'll go with strawberry. Say a price up here is not going to work because it won't satisfy the buyer. So if the exchange rate being discussed is 1T equals 3C, that is obviously an exchange rate that the seller would be very happy in. The seller would be willing to get rid of T's at 3C. Because again, the seller of tomatoes is after C's and would love to get as many of them as possible. But of course, the buyer would not play at that exchange rate because the buyer can actually get a tomato in his own garden for 2.5 corn. Why would he pay 3 corn for a unit of tomato? So this exchange rate is not going to work because the buyer will not play. It's above the buyer's maximum. On the other hand, an exchange rate way down here is also not going to work. Let's say an exchange rate of 1T equals 1C. Well, the seller is willing to get rid of a tomato in her own garden at 1T equals 1.5C. In other words, the seller can get 1.5C for a tomato in her own garden. Why would she ever make a tomato and try to trade it away for only 1C? So this exchange rate down here is effectively, sorry about that, I covered it, is too low, and this exchange rate up here is just too high. And so that exchange rate has to fall somewhere within the trading zone for both buyer and seller to be happy. So let me go ahead and I'm going to move this picture, and we're going to move that picture up a little bit so we can write a little bit more on here. So mutually mutually advantageous trade. Sorry for my handwriting here. My wife and I were just outside and my hands are still cold. I apologize. My right hand hasn't awakened yet. You're going to have to see, if you're going to have mutually advantageous trade, you're going to really have to see two conditions met. Sellers specialize in the product in which they have the comparative advantage. I'll just abbreviate that. I got to move that. So let me go up here. And we're going to move that up a little bit. And then two, second condition, the exchange rate must fall in the trading zone. That's an N, not an M. My hand has not awakened yet. Okay, and then of course any exchange rate outside that zone won't work. So these are two what we would call necessary conditions. The traders have to trade along the lines of their comparative advantage, and that is specialize. So one of the producers will have to specialize in tomatoes in our example, one will have to specialize in corn. That specialization needs to take place along the lines of the comparative advantage. And then once we have the buyers and sellers assigned, you'll have a trading zone for each product. And in this case we talked about the tomato example, and the exchange rate must fall within that trading zone. If those two conditions are met, then you're going to have conditions readily available for mutually advantageous trade. In other words, when two producers trade along these lines, they will both walk away from the deal benefiting. And that is the end of our lesson. So I hope you've enjoyed, and stay tuned. We're going to ready ourselves for Lesson 3.